welcome to this Moneycontrol live stream. You're watching Earnings Express with me, Nandita Khemka. Well, today we'll be taking stock of the fourth quarter earnings season that has just concluded, and of course, which were the key winners and losers this time around. You know, Q4 in fact may not have seen a lot of fireworks, but it is still much better compared to what we saw in the last quarter. To talk about the overall earnings picture and and to take stock of the winners and losers of this quarter that has just concluded, I'm now joined by two gentlemen. Joining me is Siddarth Bhamre of Religare Broking and Kuunal Shah of Carnelian Capital Advisors. Good morning, gentlemen. Good to have you on the show. Sid, let me come to you first. What do you make of the overall earnings season this time around? Would you say that we are at an inflection point, or it's just the start of a recovery, or would you call it lackluster?
Good morning. Thanks for having me on your show. I won't say we are at inflection point, but what's the good part of this earnings season, which we are almost finishing, is we were not disappointed. Yes, there were early hiccups through IT, but then after initial hiccups, we have seen that the other names didn't disappoint as much as Infosys. And even if you look at the stock prices of IT, they haven't done anything more damaging after that, first 1 or 2 days. Even if you look at the other sectors, we have seen that there may not have been a great top line growth, but then as inflation is coming down, as input cost pressures are coming down for various sectors, we have seen at least margins holding on, or in a lot of cases, there is margin expansion. And as market consolidates, and it continues to consolidate since last 1.5 to 2 years, I think this earnings are now catching up. And certainly this market has not disappointed when it comes to earnings. And what we feel at this point of time is that market is more attractive at these levels, what it was compared to 3-4 quarters down the line, before. And selective exposure can be taken in this market. Earnings have not disappointed, but not an inflection point. I think a couple of quarters can be more challenging going forward as the globe is moving into a recessionary period or a slowdown period. And though we are doing pretty well on standalone basis, the trickling effect of what is happening in West, what's happening in China would have impact on us. So in our coverage, we have seen that there has been upgrades, but the price action has been so significant in last 1.5, 2 months that not many places we are seeing significant upside. So yes, it has been a great earnings season, but nothing which would make us get too excited.
Well, too early to get excited. That's the view from Siddarth. Kuunal, coming to you, what's your overall assessment? And Q3 saw fairly, a lot of downgrades. But this time around, would you see more upgrades than downgrades, barring the IT pack? And how would your EPS estimates for Nifty look like for FY24?
Thanks, Nandita, in the first place for having me on the show. Well, I'll put it across this way, that Q4 has been much better than Q3. And going ahead, largely things look much better than what they were before. But for sure, it doesn't take away, certain pockets where things will not be as easy, at least for the next few quarters. Right. So that's the key monitorable as to how things pan out, in the global markets. At the same time, there's election coming up in India, so markets will be kind of volatile. The spending that the government has been doing will have to be monitored, which is giving a push to the capital goods sector and the infra sector. But overall, things look much better than they were a quarter back. But at the same time, not taking away 1 or 2 quarters, things yet need to be monitored closely.
Right, we need to monitor things closely, for the next couple of quarters. But Kunal, tell me, banks took the leadership this time around. They were the big stars this earnings season, and that forms a very heavy part of the Nifty. But given the outperformance, do you think it's already in the price? And secondly, there could be some bit of margin, weakness that one could expect when it comes to banks. As I said, a lot of it is already in the price. So, which sector do you think will take leadership in the current fiscal? And secondly, do you think banks can still generate alpha given the fact that they have already run up a far bit now?
Generally, what happens with banks is whenever economy is growing, right, the credit growth is a multiplier of the GDP growth. So, credit keeps growing at about 1.5x, 1.8x of generally the GDP growth, right? So, FY23 saw a phenomenal loan growth, which would be difficult to replicate in FY24. So obviously the loan growth momentum that was there in FY23 will slow down in FY24 for sure, but still there will be loan growth. When we hear the commentary of the banks so far, they are very optimistic on the loan growth, largely which was coming from the retail side continues. SME has started to see some kind of momentum as well. Capex part on the corporate side, yet not very visible green shoots, but we'll have to see how that kind of pans out. So loan growth will obviously be there in FY24, albeit not as much as we saw in FY23. Now coming to your question on NIMS, yes, NIMS kind of have peaked out for a lot of banks. But again, over here, a lot of unsecured book is kind of getting built in the system and growing, which helps on the yield side of the banks. And at the same time, a lot of banks have got a lot of strong liability franchise. So we saw that the cost of funds have not grown at a pace which has, in comparison to the yields that have grown on the asset side. So NIM compression, yes, NIMs might sustain. Compression will be too early to say whether it will happen or not. It's a little contra view, but we'll be watchful of the same. So banks should do good. Now coming to the question whether it is there in the price or not, again, I believe 1 or 2 quarters, yes, banks might not do much from here on. But overall, if economy tends to do well, banks will tend to kind of do good. So that's 2 cents on bank. Now coming to which sectors should kind of take leadership going ahead, I think IT is something where we saw margins coming back in the current quarter, which were compressed because of the employee attrition and demand of employees skyrocketing. So margins have kind of come back. When we see minute details of major IT companies, yes, the order wins have kind of slowed down, but they are not as bad, in comparison to the historical order wins. So IT is something which probably can do well if there is not much of pain in the, not much of further events in US. So that is one thing which can kind of do it. Pockets of capital goods also saw a very good traction in their order book. Also, margins uptick was also visible in quite a few capital good companies. So that is the other sector which basically should probably do good in the next 2-3 years. Again, over here, how political scenario plays out will be a key monitorable. There are certain companies which do decent work on the export front, so they should continue to do well. We also saw very good numbers from the auto and companies. So that is also a sector which has done fairly good in comparison to the other sectors. So that is also a sector which we believe can kind of continue the momentum.
Right. Kunal, I think you've covered quite a few sectors in this answer. We'll come back to them individually. But, specifically when it comes to banks, which one would your preferred bet be now? Private banks versus PSU banks?
I'll put it across any bank which has got a good liability franchise, right, and has got good competitive cost of funds are the ones which will kind of do well going ahead as well. It would be a mix of both private and PSUs, and within that, large private banks and mid banks.
Right. Kunal, you mentioned about IT taking leadership. So I would want to throw a question to Sid on this. I was pretty surprised when Kunal said that IT could take leadership in the coming quarters, given the fact that the outlook remains hazy. What's happening in the West with the US banking crisis, tightening credit conditions, and what have you. There has been, the companies have said that the clients are, rethinking their spends and, they're tightening their purse strings. So the outlook per se looks hazy when it comes to these IT stocks. But, given the fact that most of these stocks are now near about their long-term averages, Sid, would you say that the valuations are mouth-watering and it's actually the time to take positions in some of these heavyweights like TCS, Infosys at this juncture?
Well, I wouldn't say mouth-watering, but definitely in an attractive territory. See, people are worried about what would happen to US, and the recession in US, slowdown in Europe would have negative impact on IT. But one needs to understand that the spending of IT is not just about, a company doesn't spend on IT just to ensure that the top line is growing. They also spend on IT for cost of optimization, cost rationalization. And last 2-3 quarters, we have seen different management talking about it, that a lot of spending in IT is happening, or a lot of spending on IT is happening on cost optimization front. And hence, I believe that
I think there's been an issue with Siddarth's feed. We'll come back to Sid on the IT pack. But Kunal, coming to you on realty, most of these stocks, in fact, companies like DLF and Oberoi Realty have seen fairly good performance, coming in 40 to 50% jump in profit. In fact, for Oberoi Realty, it was higher. Given the fact that the RBI may be near its rate hike cycle, in fact, the rate hikes, it's almost done with its rate hikes, and we saw the RBI doling out a pause in the previous policy, and even this time around, it's expected to stand pat on interest rates. Given the improving macros and the fact that we are at the end of the rate hike cycle, would you say there's a case to buy into some of these realty stocks now?
See, historically, it's actually very difficult to pick any real estate stock, because it's still largely a micro market. There are very less pan-India players to kind of take a bet on. But largely speaking, I think building materials is a space, which is an indirect proxy to real estate. Which can be looked upon now with kind of things picking up in the real estate space. And we just one important point over here is, the EMIs of a lot of loans that were being given to the real estate kind of shooted up drastically. But still, the loan growth momentum that we are seeing in the banks on the real estate front is kind of not slowed down. So obviously, there is quite a momentum that is kind of building up in the real estate sector. But again, I would put it across that there are very less pan-India players to kind of take a bet on any real estate company. And there are a lot of micro markets where a lot of players operate, which kind of makes it difficult to have a view on the real estate sector per se.
Right. I think Sid is back, so we'll go back to him and ask him about the large cap IT space as well as mid cap IT. Sid, most of these companies like Mastech, Persistent have done exceedingly well, contrary to what the larger peers have done. What's your outlook there now?
That's for me.
Yeah, it's for Siddarth.
Yeah. So. Just completing, what I was trying to say previously, that we should not be negative on IT. No, not about mothering, but we are seeing, decent amount of buying happening in IT, and valuations are attractive. Be it Infosys, SCL Tech, Wipro, and we are liking SCL Tech a lot among the large cap space. Mid cap IT, Nandita, I will wait for some time. We have Birla Soft under coverage. We have given a buy call on it. We have the target price has met because last few days that stock has done pretty well. But looking at the macro context and the global scenario, though we maintain our stance that we are bullish on IT, I would refrain right now to have exposure in mid cap IT space. And there's not much of valuation gap between mid cap IT and large cap IT. So if I'm getting a large cap company at more or less same valuation, I think I would not be too adventurous and go for mid cap.
Right. Wait it out when it comes to mid-cap IT, and large-cap IT valuations are turning attractive, and there's no need to be negative on IT right now. That's the view from Sid. Kunal, let's pick up from where we left off. There's a lot of optimism, as you mentioned, around the capital goods space and the construction space as a whole. L&T, among others, clocked in very strong order book. Guidance for order book is also pretty good when it comes to FY24. But the street was fretting, because on the margin front, it was a big disappointment. But, given the government's thrust towards infrastructure and, and construction, would you say some of these capital goods companies makes a good play right now, including the likes of defense and railway stocks that have done fairly well over the last couple of years?
So, in capital goods, again, it's a very large space, right? Like in IT, right? There is IT services, there is ER&D, then there are a few product companies, right? So, similarly, in capital goods, it's a very large space as such. And we like capital goods space because we see there is opportunity in niche companies which have got core competence. So what has happened for them in the last few years is domestic demand gives them the momentum, but also exports opportunity has opened up for these niche companies, right? So even if domestic demand slows down a little bit, right, the export opportunity is such a big market. Even if we get a small market share out there, it turns out to be a big opportunity for these niche companies in the capital goods space. So again, in capital goods, the larger ones like probably ABB, Siemens and all, would have very rich valuations, and it would be difficult to take a call from here on, despite them having very good order wins and very good margins also. But again, there are niche companies in mid and small cap space, which offers good, interesting opportunity. Coming to your question on L&T, yes, margins have been something which have been not picking up for L&T in their core infra book and remains a key monitorable going ahead as well, with the commodity and inflation pressure kind of now easing out. But yes, order book momentum remains strong, and we believe it should continue for a while for L&T when it comes to the order book.
Right. From manufacturing, let's shift focus to consumption. Then, Sid, coming to you, for most of these FMCG biggies, profit margins have been good, but it's a volume, it's the volume front that has disappointed, even when it comes to the likes of HUL because of patchy rural recovery. So, what's your view on the entire consumption pack after the fourth quarter numbers?
So, we are bullish on this space. Firstly, again, the basic theme is that the raw material prices are coming down, and especially the crude oil prices coming down. That augurs well. And most of this has happened, in last couple of months. So the impact of that is yet to be felt. So I'm quite optimistic in, coming quarter for FMCG space. If you look at, specifically stock-wise, then yes, ITC has done well. We have that stock under our coverage, but it's more of an accumulating where stock prices have run up. So we would not, be very aggressive over there. We are telling our clients to, hold on to their investment positions. But then fresh upside price revisions we have done, but we are not seeing very significant upside immediately in that name. If you look at HUL, which we have been, talking about, yes, stock has not done great compared to, other large cap names, but we are quite optimistic even from, current price point perspective. We have decent upside of around 16% left for our target price for HUL, which is around 3,068. Again, we have not revised target price upwards, but we are anticipating some margin expansion happening. The other point I want to highlight, from a macro perspective, Nandita, in this space is post-COVID, we haven't seen rural economy contributing significantly. But if you see at the recent employment numbers, then we are seeing revival in rural economy, and that would add a fillip to FMCG space. And if I have to club paint stocks also in the same, then we are quite optimistic on a couple of names like Asian Paints and Berger Paints. So fairly optimistic, decent valuation support. So FMCG space, one can have decent amount of exposure in portfolio.
Right, since you're talking about consumption, let's also talk about autos. After a fairly long patch of underperformance, autos have done pretty well this time around. Maruti has done well. In fact, it has announced capacity addition as well. That means demand is there. You have Tata Motors that fired on all cylinders. Two-wheelers also not done all that bad, given the fact that Eicher and Hero Moto stand out. But in FY24, Sid, do you expect autos to take the lead?
Yes, and we are overweight on auto, and not just two-wheeler space. In fact, two-wheeler space we had Bicol and Bajaj Auto stock has done phenomenally well. Right now we are not seeing very big upside in that stock. But even if the export numbers were under pressure, we have seen Bajaj Auto maintaining its margin and posting decent growth. But I'm more optimistic on Eicher over here. Record numbers on the Enfield, CV doing well. Valuations are not very expensive. That name, whether you want to put it in CV or two-wheeler space, that name in auto space is doing well. But our top pick within auto space is Maruti. Last 5 years, last time also I spoke on your show that last 5 years the stock has not done anything great. It has been consolidating, but the valuations are pretty attractive. It's trading at the lowest P multiple in last 5 years, and look at the numbers which it is throwing. And interestingly, Nandita, the CV space, or sorry, the SUV space is gaining more weightage, and we all know that the margins are pretty high. So Maruti has posted good numbers in terms of number of vehicles sold, but also margin expansion is there. I feel that the stock would give great returns from next 1-2 years perspective, and we are overweight on Maruti when it comes to portfolio. There are other names which are doing well. M&M from both from tractor space as well as from SUV space is doing pretty well for itself, especially the SUV market. So that is also one of the stock which you are liking. So there are a number of stocks in auto space which are doing well. So we are overweight on auto sector at large.
Right, overweight on autos. Kunal, my last two questions to you. I think we are completely running out of time. But, from the pharma basket, we have seen margin pressure for some of these pharma giants. And, given the exposure to US, do you think the pain is likely to continue for the next few quarters? And if at all, one should look at some of these pharma stocks, which one should they be now?
We hold Cipla in our portfolio and we like the franchise. So when it comes to pharma, for us, it is pretty simple. Strong domestic franchise and having a specialty or niche portfolio when it comes to the US markets is basically something which should kind of do good in the next 2-3 years, because in generics, the pricing pressure will kind of continue. So companies will have to kind of come up with new molecules at regular intervals to kind of offset the pricing pressure and have growth. So I think in pharma, it's pretty simple to go with franchise which have a very strong domestic franchise, because the Indian pharma market will keep growing at about 8 to 10%, both acute and chronic put together. And at the same time, if in US you are getting a franchise which is building a niche business, like for Cipla, which is building a strong respiratory portfolio and is ahead of the curve, then this kind of companies basically should do good over a period of next 2 to 3 years.
Right, Kunal, my last question to you on new age companies. I don't know whether you're in a position to comment on some of these, given the fact that, the likes of Paytm, Zomato, they have given some color on when they will be turning fully profitable, which is 4 to 5 quarters from now. So now, would you say the tide has turned when it comes to some of these new age tech companies?
Well, I'll put it, it's too early to say as of now as well, because there's a lot of disruption that is happening in that particular space. Now, ONDC is coming up. We have already saw initial round of success that ONDC has had. So it will be too early to say as of now as to who would be the winners in this particular category in the long run. We don't own any of those in our portfolio as of now.
Right, so that's the call on new age tech companies. Well, with that, Sid and Kunal, thanks a lot for taking out time and joining us this morning and sharing your perspective with us. To our viewers, I think we are completely timed out on this edition of Earnings Express. So thanks a lot for watching. Stay tuned to Moneycontrol for all your other news and updates.